One Up on Wall Street is a book written by Peter Lynch, a former mutual fund manager and one of the most successful investors of all time. The book was first published in 1989 and has since become a classic guide for investors looking to make successful investments in the stock market. Here are some takeaways from One Up on Wall Street. Successful investing is not about predicting the future or trying to time the market. Rather, it's about doing your own research, understanding the businesses you invest in, and taking a long-term view. Peter Lynch emphasizes the importance of focusing on companies that you have a personal connection to or that you understand well. By investing in what you know, you can gain an edge over other investors who may be more focused on market trends and speculation. The importance of patience and discipline. Lynch advises investors to have a plan and stick to it, even when the market is volatile or uncertain. He also emphasizes the need to ignore short-term fluctuations in the market and focus on the long-term potential of your investments. Look for growth opportunities. Peter Lynch suggests investing in companies with potential for growth, rather than those that are already established. This involves looking for companies with innovative products, expanding markets, and strong management teams. Understand the company's financials. Lynch stresses the importance of analyzing a company's financial statements to determine its health and growth potential. This includes examining metrics such as revenue growth, profit margins, and debt levels. Be aware of the risks. Investing always involves some level of risk, and Lynch advises investors to be aware of the risks associated with their investments. This includes understanding the industry trends, competitive landscape, and regulatory environment. Don't follow the crowd. Lynch encourages investors to think for themselves and avoid investing based on the opinions of others. Instead, he suggests doing your own research and trusting your own judgment. Keep emotions in check. Lynch emphasizes the importance of keeping emotions in check when investing. He warns against getting caught up in the hype surrounding a particular stock or making impulsive decisions based on fear or greed. Successful investing requires a disciplined and rational approach. Use your own experiences. Lynch suggests that investors can find great investment opportunities by using their own experiences and observations. By paying attention to the products and services they use and enjoy, investors can identify companies with strong potential for growth. Stay diversified. Lynch stresses the importance of diversification to reduce risk and maximize returns. He advises investors to spread their investments across multiple sectors and industries to avoid having all their eggs in one basket. Invest for the long term. Lynch advocates for a long-term investment approach and warns against trying to time the market or make short-term trades. By focusing on companies with strong fundamentals and long-term growth potential, investors can achieve greater returns over time. Learn from your mistakes. Lynch acknowledges that not all investments will be successful and encourages investors to learn from their mistakes. By analyzing what went wrong with a particular investment, investors can avoid making the same mistakes in the future. Keep it simple. Lynch emphasizes the importance of simplicity in investing. He suggests avoiding complex financial instruments and focusing on straightforward investments in companies with strong fundamentals and growth potential. Simple, well-researched investments are often the most successful. Avoid market timing. Lynch advises investors to avoid trying to time the market, as it is nearly impossible to predict short-term market movements. Instead, he recommends focusing on finding great companies with long-term growth potential. Do your own research. One of Lynch's main messages is that investors should do their own research and analysis, rather than relying on the opinions of others. This involves reading financial statements, industry reports, and other sources of information to make informed investment decisions. Invest in what you know. Lynch advocates for investing in companies and industries that you understand well. By focusing on areas of expertise or personal interest, investors can gain an edge over others and make more informed investment decisions. Stay disciplined. Successful investing requires discipline and patience. Lynch advises investors to stick to their investment plan and avoid making impulsive decisions based on short-term market fluctuations. Keep a long-term perspective. Finally, Lynch emphasizes the importance of taking a long-term perspective when investing. By focusing on the long-term growth potential of a company, rather than short-term market movements, Investors can achieve greater returns and avoid making emotional decisions based on fear or greed. Overall, One Up on Wall Street provides a practical and accessible guide to investing that emphasizes the importance of doing your own research, understanding the businesses you invest in, and having patience and discipline in your approach. These are timeless lessons that can help investors achieve success in any market environment.